1. The W-2 trap. The biggest tax secret in America is that rich people usually do not earn money the way you do. If you're a normal employee, your paycheck gets hit before you even touch it. Federal tax, state tax, Social Security, Medicare. Your paycheck basically enters a UFC cage match every 2 weeks. You make $80,000 a year? Depending on your state, you might only see around $58,000 to $62,000 of it. Meanwhile, a billionaire can technically report a lower taxable income than a dentist in Ohio, because the U.S. tax code was designed around ownership, not labor. Back in the early 2000s, our parents thought getting a stable office job with dental insurance meant you made it. You sat under fluorescent lights while Internet Explorer crashed for the 4th time that day, and your Dell desktop sounded like a lawnmower trying to boot Windows XP. But wealthy people learned a completely different game. They avoid high salary income whenever possible. Instead, they take loans against stocks, earn capital gains, buy appreciating assets, and run businesses where expenses become deductions. That's the key shift. Employees get taxed first and spend what's left. Owners spend first and get taxed on what's left. And once you realize that, the entire system suddenly looks very different. 2. Retirement accounts are basically legal tax cheat codes. The wild part is that the government literally gives normal people tax loopholes too. Most Americans just never use them. A traditional 401k lowers your taxable income immediately. You put in $10,000? The IRS pretends you never earned that money in the first place, which means two people can make the exact same salary and owe completely different taxes just because one person understands retirement accounts. In 2026, the 401k contribution limit is over $23,000 for many workers. Add employer matching, and suddenly your company is handing you free, untaxed money, while most people are busy financing a $78 Stanley Cup collection and another streaming subscription they'll forget to cancel. Then there's the Roth IRA. This one flips the system completely. You pay taxes now, so your future withdrawals become tax-free forever. Imagine explaining this to your 19-year-old self spending $11 on LimeWire-ripped ringtone packs and bootleg MySpace layouts. Compound growth inside a Roth IRA can become absurd. If you invest $500 a month starting at age 25 with average market returns, you could end up with over $1 million tax-free by retirement. Tax-free. That's one of the closest things normal Americans have to billionaire-level tax treatment. And most people ignore it because retirement sounds emotionally fake when you're eating microwave burritos at midnight, wondering why eggs cost more than graphics cards now. 3. Rich people love debt, but not the kind you're thinking of. Average Americans use debt to buy liabilities. Rich people use debt to avoid taxes. Huge difference. When billionaires borrow against stock holdings, the loan itself is usually not taxable income. That's the loophole. Let's say someone owns $50 million in stock. Selling the stock triggers capital gains taxes, but borrowing against it? That's often tax-free cash. This strategy became infamous with ultra-wealthy founders in Silicon Valley. Instead of selling shares, they used low-interest loans backed by appreciating assets. And because stocks historically rise long-term, some people just keep refinancing the debt while their wealth grows. It sounds fake the first time you hear it, like one of those early internet urban legends your cousin emailed you next to a dancing skull gif and a warning about deleting System 32. But regular people can actually apply a small version of this concept intelligently. Low-interest debt used for appreciating assets can be powerful. Examples: business loans, real estate investing, 0% balance transfers used strategically, building business credit. The problem is most Americans use debt emotionally. Cars, clothes, DoorDash, buy now, pay later apps. Humanity invented artificial intelligence, and somehow we still finance chicken sandwiches in installments. Wealthy people use debt to acquire assets. Everyone else uses debt to look wealthy. That's the trap. 4. Side businesses unlock tax deductions most employees never see. This is where things get really interesting. The second you start a legitimate side business, the tax system changes around you. Not magically, legally, because businesses are allowed to deduct expenses connected to generating income. Laptop? Possible deduction. Home office? Possible deduction. Internet bill? Partially deductible. Camera gear, software subscriptions, mileage, advertising, travel? Potentially deductible. And this is exactly why wealthy people structure everything through businesses. The U.S. tax code is full of incentives designed to encourage economic activity. YouTube channels, freelancing, consulting, e-commerce, rental properties, even a tiny side hustle can open deductions unavailable to normal W-2 employees. Remember when side hustles used to mean burning CDs for your friends or flipping Xbox 360 games at GameStop for enough money to buy half a burrito? Now a random person with a phone can generate business income from TikTok affiliate links while sitting in sweatpants. The internet changed everything. But here's the important part. Fake write-offs are illegal. The IRS is not stupid. You can't deduct your entire apartment because you answered 3 emails near a lamp one time. Your business needs real intent to make profit. Still, understanding deductions alone can save thousands per year. And that's exactly what wealthy people understand better than almost everyone else. 5. Capital gains taxes are why investors play by different rules. Here's the sentence that makes millions of workers angry every year. Long-term investment gains are often taxed lower than job income. If you hold investments longer than 1 year, federal long-term capital gains tax rates can be significantly lower than ordinary income tax rates. That's why investors obsess over holding periods. And it's why the wealthy prioritize assets over salaries. The tax code rewards patience, not effort. You could work 60-hour weeks at a stressful corporate job surviving on cold brew and anxiety while someone holding index funds quietly pays a lower effective tax rate. Very motivational system. But regular people can use this too. Index funds, ETFs, retirement investing, long-term investing discipline. This is the part nobody explained to millennials growing up. We were taught, go to school, get a job, work hard, save money. Meanwhile, asset prices were sprinting into the atmosphere like a 2007 YouTube video titled Crazy Frog Extreme Compilation Final_Final 2.mov. The wealthy figured out something critical decades ago. Labor income alone rarely creates financial freedom. Ownership does. And once you understand how taxes reward ownership, you stop looking at money the same way forever. 6. The real secret is that the tax code is basically a giant behavior manual. This is the part most people miss. The tax system is not random. It's incentive engineering. The government wants certain behaviors: investing, building businesses, buying homes, creating jobs, saving for retirement. So the tax code rewards those behaviors financially. That's why wealthy people often look like they're playing a completely different game. Because they are. Most Americans focus only on income. The wealthy focus on tax efficiency, asset appreciation, equity ownership, long-term compounding. And over decades, the gap becomes enormous. A person earning $90,000 while investing consistently and minimizing taxes can quietly outperform someone making $150,000 who spends emotionally and ignores investing completely. That's the uncomfortable truth. Money is less about how hard you work, and more about understanding the rules attached to it. Which honestly feels unfair when you remember our generation got financial education from sitcoms, pyramid scheme Instagram ads, and a high school economics teacher who still used an overhead projector from 1994. But once you learn the system, you can start using parts of it yourself, legally, slowly, strategically. And that's exactly how wealth actually begins.